Hi everyone, welcome back to Slevin Figures. It's been about 2 weeks since I last did an episode, and as you can see, the portfolio has actually grown to now $21,000. So pretty sizable portfolio. And in today's episode, I'm going to be going through the quick overview of the growth, the dividend, and the Bogleheads or balanced portfolio. This is episode 7. But as part of the coverage, I'm going to do a deep dive on the financials, which currently are the largest part of the dividend portfolio. And that portfolio has been doing pretty well. And looking at that portfolio, what I'm going to be focusing on is primarily four things. Going into the return on equity, operating margins, price to book, and then lastly, price to earnings. We'll also look at the dividend payout and the dividend payout ratio, kind of explain why you have to be careful when evaluating dividend paying stocks or growth dividend stocks. So let's head over to the portfolio overview. So as in past videos, we'll start off with the dividend income portfolio. This portfolio is like we've talked about in earlier videos. If you want to go check out the other videos, it's focused on just dividend paying stocks. So nothing in here can actually be a stock that doesn't pay dividends or a company that doesn't believe in paying dividends. Currently, the portfolio size is $7,149.30. It's up 6.69%. And this started in June of this year, so only about 5.5 months. And that equates to $299. When you take a look at here, because this is focused on dividends, I like the market gains, but these are not the primary focus of this account. We will take these because we want them in there. We can see that we've been paid $81.51 just in dividends. And I'm using M1 Finance as a platform for this. Part of the reason why I like using it is because you can see here the graph of how everything's going. And you also have the pie here representing the different investments that you have. In the dividend portfolio, I'm going to scroll down here to look at what's been doing really well. Starting with financials, they're up 16.86%. This was the biggest part of my portfolio from the very beginning. I was investing a lot in financials or believed in financials, even though everyone was bashing them in the summertime. And a lot of people on YouTube were loaded up on utilities and REITs due to the market volatility. I really like financials. They're a big part of my personal portfolio outside of this experiment. Next, bonds. They're only up 4%. And they're in here just to stabilize this portfolio, not really to provide growth. Then you have healthcare, which is up 20%. Obviously, we all need healthcare. If you're sick, you're going to pay whatever you got to pay to get back to being well. So this was always going to be a bigger part of the portfolio. Then you have utilities, which are really stable. These are very similar to bonds, and you can see they're only up 6.4%. Technology is next. It's up 11%, and it's a lot of Apple in here. Energy is a sector that I want to be increasing allocation to within this portfolio just because I think it's been beaten down a lot, and we're not going to go to electric everything overnight. So I'll probably be bumping this up to 10% from being 9% of my portfolio. Consumer discretionaries have been kind of a disappointment. McDonald's and Starbucks are not doing that well. But I think that in the long term, the consumer is always going to do well. So I'm going to keep it at 8% of the portfolio. Then we have industrials up 11.2%. REITs are just up 2.37%. And REITs are just in there because, they're dividend paying. They meet the criteria. But I've always believed that there shouldn't be a big part of your portfolio, just a small part. And then consumer staples up 12.6%. These do well when the economy is doing well. They do well when the economy is doing poorly because they're staples. You need cereal, you need stuff like that. You're not going to get rid of it. Cigarettes will do well. And then communications, this is just AT&T, Comcast, all the companies that we hate but can't live without. They're all in here, so they're doing well. Disney's in here too. And lastly, alternatives. This alternatives is mainly actually private equity firms. So this is a private equity. This is an aluminum. It's a lithium miner. So they mine lithium. And I think that as electric cars take off and they become the norm, we're going to need more electric. We're going to need more lithium to make batteries, and then of course private equity here. So this is just a small part of the portfolio, and I might keep shrinking it actually. When I look at it, it's 5%. It might go down to 4, and I'll take that 1 percentage point and add it to something like energy. So that's the dividend portfolio. Doing pretty well. Happy with its performance. It's up, almost 7% in the last 5 months. Then we'll shift over to growth. Now, looking at the growth portfolio, it's been anything but really growth. However, long term, I have a lot of faith in this portfolio actually accelerating and overtaking the dividend portfolio. It's only up about 1%, so it's up 0.99% since June. It started at the same time as the other portfolio. So $45 is all it has in terms of gains. Most of these are market cap gains. So $42 in market cap gains and $3 in dividends. And it's now sitting at $6,842. In this portfolio, I have all the usual suspects when it comes to growth. So Tesla is my number one position in this portfolio. It's 15% of the portfolio, but it's sitting at 16.3 because it's grown a lot. So Tesla's up 59%. For all those people who are out there who are Tesla haters, this is going to be a great company. You can see it. Amazon is down 8.7%, but I believe Amazon will actually, turn around and do very well. Google is up 21%, and I'm not surprised by that. It's just a strong company. It's really undervalued, even at 21% growth this year. It should be up more. And then the biggest drag on this portfolio is really Beyond Meat. I invested in this company thinking that it's going to be like the replacement milks because, I drink almond milk. I don't drink regular milk. My wife drinks soy milk. Everyone I know is not drinking milk anymore. They're all drinking some milk alternative, basically. So I think in the long term, people will turn around and Beyond Meat will actually do much better. So while it's down, I'm actually investing more in it. I'm going to keep the allocation at the same rate and keep buying shares while they're low because this company is already profitable and it's been on the stock market for less than a year, and they already reported positive earnings. Tesla has been on the market for years now, and they're just starting to report positive earnings. So I have a lot of faith in Beyond Meat. Facebook, probably one of the most undervalued companies out there. It doesn't grow as fast as it should, but it's a huge organization. They print money. Alibaba is up 25%, but I knew that was going to be the case because of all that China noise you see on TV. This company just keeps chugging along, printing money in China. Microsoft doing really well. They're even stronger in cloud computing than they used to be. And then Uber is down 34%, but they deserve it. They haven't hit their numbers. They're not profitable. I just think it's a great company. I use their services all the time. So I think at some point they'll find their footing and be a strong company. And then AMD, I own actually a lot of shares of AMD in my personal account that I keep for retirement reasons. I own way more shares there, and it's up over 100% in there because I bought it at $15. And this one is done really, really well. I think they've got a long runway to catch up with Intel on the CPU side, and then to catch up with NVIDIA on the GPU side. Then you have Invitae, which is genetics company. I think they're going to do really well in the future, but they're struggling right now to actually get their profitability where it should be. And then lastly, Netflix. Again, one of those companies that I use their services a lot, and I love it. So I can't find a reason why I shouldn't own the company. I know that Disney's out with their streaming services, so is Apple, and I have an Apple TV. But I haven't bought Apple TV's plan, which is just $4.99. And I don't care about the Disney plan. I keep using my Netflix because I just enjoy it. So I'm going to keep holding on to it. I think it's a great organization that will find its footing long term. So that's really it for growth. It's been disappointing so far, but investing is all about long term. So 6 months is nothing. This portfolio will be able to tell how it's actually doing 5 years from now. Now we'll move to the Bogleheads portfolio. This is the portfolio that I recommend for almost everybody in my family who doesn't want to spend time learning about investing. It's an easy portfolio based off of the Bogleheads platform, where the lazy 3-fund portfolio. Now we've turned it into the 2-fund portfolio because we can actually do it with just 2 funds. This is up, and this goes back to showing why indexing works. Doing almost no work at all, this portfolio is up 5.14%. Pretty close to the 7% that I have in dividends, but I had to do a lot of homework there. So it's up $238. The other one is up $299, and you can see $46 from dividend payouts and $192 from market gains. This is strong proof of why indexing really just works. And then the total value of the portfolio now is $7,038 at 45 cents. So it's beating the growth portfolio, and it's pretty close to the dividend one, but we're doing zero homework. I'm maintaining a 50-50 split. So 50% of this is total bond market, and 50% of this is the Vanguard Total World Index Fund. So as in the past, I've said the Total World Index Fund actually has this fund right here, covers all the stock and equity around the world. So something like 8,000 or 9,000 stocks are covered in this portfolio. And it's done really well. You can see $15 in dividends, 170 in capital growth, and it's up 8%. So this is actually beating the dividend portfolio by itself. It's being dragged down by the Vanguard Total Bond Market portfolio, which is only up 2.2%, and it's all just mostly dividends and a little bit of capital gains. So if I had just put all the money in the Vanguard Total World Index Fund, I would have been beating the dividend investing portfolio and the growth portfolio. And this is a strong case of why people say everyone should just be an indexer and put their money in an index fund. You're going to get the market cap growth or market value growth, as well as capturing the dividend growth. It's not going to be as high in terms of dividend payout, but it's going to be a decent amount, probably around 2%. You're still beating the 10-year Treasury note. So that's one of the strong cases for why Boglehead or balanced investment does make a lot of sense. And this fund is automatically rebalancing itself. So that's why you see the value being so close, even though the Vanguard Total World has been growing significantly, being up 8%. Additional monies that are deposited into this account go into the bond to keep it at a 50-50 balance, which I'm happy with for now. And I may do something different in the future to actually make this work. Now, I did say that I was going to do a deep dive on the financials in the dividend portfolio. So let's go ahead and take a look at that, and then we'll finish up this video. Now, taking a look at the financials within the dividend income portfolio, you can see it's the dividend income portfolio. These are the financials. I only have 4 stocks in the financials now. I used to have about 8 or 9, and then I realized quality over quantity. Let's focus on the ones that really, really do well and the ones that I want to keep my money in. So this portfolio is up 16.86%, the financials are, and at $74. Let's see what part of that $74 is dividends. So $9 are dividends and $65 is market gains. So the companies have become more valuable, but the dividends are still supporting it. The 4 that I do have in here are Wells Fargo, JP Morgan Chase, Bank of America, and Synchrony Financial. A lot of the growth has come from JP Morgan Chase. It's up 30%. Bank of America is up 25%, and Wells Fargo is up 22%. You'd never know this if you were listening to the financial news networks, especially CNBC or Fox Business, because they were all just bashing financials and saying they're dogs, they're dead, they don't matter. Now, I'm going to use Yahoo Finance maybe to show you how I look at these financials and evaluate them. We'll switch over to Yahoo Finance now. We're here on the Yahoo Finance page, and what we want to do is, just type in here, or I should just do it here, Wells Fargo, and Looking at the financials, we jump in here, and there are really a couple of things that I look at when evaluating this. So earnings per share, one, the company is earning $4.65 a share. They're paying $2 of that in dividends, which gives us a yield of 3.87%. So we know what we're going to be getting. And is this company cheap? Well, it's kind of cheap when you compare it to the market, right? So the S&P 500 is trading at around 17, 18 times payout. When you buy Wells Fargo, you're paying 11.7 times the earnings. So you just multiply that times this times the earnings, and that gives you the price. So it's a relatively cheap company when you compare it to the S&P 500. So you're not overpaying for the investment. However, when I'm looking at this financials, really one of the couple of things I take a look at, price to book ratio. Since financial companies rely on their balance sheets to make money, right? The only way that a bank makes money is by making out loans. So they rely heavily on their balance sheets. Price to book will tell you how expensive the company really is, more so than even PE ratio. So the price to book here is 1.34, which is not very high, as we'll look at JP Morgan, which is even at a higher price to book ratio. The other thing that I tend to look at is we pay for profits. And if you look at banks, they're really profitable. The profit margin is 27.18% for Wells Fargo. The operating margin is 34%. That's really good. They're making that much profit off of their business because the operating margin is what they actually have. And then the effectiveness of the management is really looking at the return on equity. For return on equity is really important because what we as investors have is equity in a company. And we always should be measuring what are we getting on our return on our equity. And Wells Fargo, for every dollar you have in there, the return on equity is 11.81%. You're not going to get that kind of return giving the money to the US government and buying treasuries. You're only going to get 2%. Now it's risk-free, whereas this is risking your money because it is a company that could go bankrupt. But at the end of the day, you're not going to find a lot of investments that are going to pay you 11%. So to give you an example, let's look at a company like McKesson. And then you'll see why it's important to pay attention to these ratios. So this company is trading at $142 a share. You can ignore the price to book because they don't use their balance sheet. But look at the profit margins. It's negative on the profit margin side. Look at the operating margins. It's 1.33%. So razor thin profitability. And the return to equity is pretty much turned negative. The reason why this company would have a high share price a lot of times has to do with the float. There's only 179 million shares outstanding. Whereas if we go back and take a look at Wells Fargo, the reason why the share prices are going to be lower is because you have 3.82 billion shares out there. So that's why the value of the shares is much lower. That's why when you hear companies doing buybacks and they're going to buy a lot of their shares, it increases the value of the company because it means there are going to be less shares available, which means that's going to boost the stock price. And this is especially effective for banks. So that's Wells Fargo. We take a look at the next bank on the list, and that was Bank of America, the BAC. This is one of my favorite investments. Bank of America has a price-to-book ratio of 1.25, which is actually lower than Wells Fargo. Their forward PE is 11.3, so again, far lower than the S&P 500. Then when you look at the profitability, it's actually even more profitable than Wells Fargo was. So 32.16% profit margins and 39.17 operating margins. However, the return on equity is slightly lower than Wells Fargo was. Wells Fargo is above 11 and Bank of America is at 10.45. And again, look at the float for Bank of America. They have almost 3 times as many shares. They have 8 billion shares out there outstanding. 9 billion if you see share outstanding, whereas Wells Fargo was 3 billion. So if Bank of America was able to reduce their share count down to 3 billion, their price could actually triple. And that's why you see Bank of America has embarked on I think a $30 billion share buyback plan this year. So that's really important to understand. And then the next one is JP Morgan. Once again, I'm not going to take too long with these, but you can see the forward PE is 12.76. So it's a little more pricey, JP Morgan is, compared to the other two banks. The price to book is 1.79. Again, a little more on the high end. It's being valued more than the others. That's why I wouldn't be putting more of my money in JP Morgan. I'd probably be targeting Bank of America, Wells Fargo. And then the profit margin side of things. So you can see 32% and 39%. So right in the same line as Bank of America. That's why that's why I think Bank of America might be a better buy. But the most important thing comes up here. You look at the two things that make Bank of America a $32, $33 stock and JP Morgan a $135 stock, comes down to these two things. Return on equity is 13.3%. So that's 3 percentage points higher than Bank of America, or 300 basis points. And then the share count is only 3 billion, whereas Bank of America had 9 billion in terms of outstanding share count. So there are a lot more shares of Bank of America out there. That's why they need to buy back so much of their share to be able to boost their prices. And then lastly, we had Synchrony Financial. I think it's SYF. Synchrony Financial is a credit card company, so they're not really a bank. But like a bank, they do similar things. They loan money to people. Their PE ratio right now is 6.9. Their forward PE is 8. So it's far below the S&P 500, almost 10 points below the S&P 500. Their price to book is 1.63, which is expected because it's a credit card company, not a bank. But their profit margins put the banks to shame. You can see 41% profitability, 56% operating margins, and the return on equity is 26.1%, far above the banks. And that's because Synchrony Financial, it's a credit card company, so they don't have the same costs that are already in place or embedded in being a bank. And then when you look at their share count, it's just 646 million. Definitely going to be an investment I'm going to look at very closely for even my personal investment and my retirement account. And then what I really like is their quarterly revenue is up 25%. So growing fast, and everything seems to be under control. So this is a quick overview of the banks. And if you wanted to look at, for example, profitability of Coca-Cola, just to give you an idea of why it's important to look at that is, Coke doesn't even have the profitability of the banks or the credit card companies, but they do have really high return on equity, and they don't have as many shares out there. So really important to look at the profitability because that's really what we're paying for as investors. It's nice to look at a lot of the storylines. Like I invest in Tesla and I like it a lot. But at the end of the day, you have to go back and look at the profitability because that's really what you're taking back home as an investor, or what you're going to get in terms of your dividend payouts. So long video for today. I guess I'm making up for the last 2 weeks of not putting anything out. If you like the content, please give it a thumbs up. And if you haven't subscribed, please subscribe to the channel. Motivates me to make more of these videos. Have a great day. Thanks.